What are these structured products? They are almost the new innovations today in the financial industry. Any product whose cash flows are based on credit linked assets, like whose cash flows are based either on loans, whose cash flows are based on any other credit based claims, like credit card receivables or vehicle loans or any such kind of credit related assets. If the cash flows are based on either loans or any other credit claim, we are calling those kind of products as structured products. And we all know the structured products have come up because of the concept of securitization, where we see the banks or any lenders, they are selling off their credit linked assets like loans, different kinds of loans, or credit card receivables, or even account receivables. Any of these credit linked assets, they are being sold off to a third party, who in turn is creating bond kind of securities and issuing them to the public investors. So these kind of products that are getting created are getting classified as structured products. Now, our intention is to understand what is the credit risk that is involved with these kind of products. So, to start with, we need to understand what are the various types of structured products that are available in the market today. Right? Then we can try to look at how we try to address the credit risk in each one of them. So to start with, we are talking about the covered bonds. Right now, as one of the structured product, I am looking at the covered bonds. Typically, they are called as on balance sheet securitization instruments. Why so? It's not an off balance sheet. This is one thing we need to be understanding. When I say on balance sheet, all we are doing is, okay, let's say a bond has been issued. A bond has been issued, and against this bond, to secure this bond, a a set of mortgages is segregated from other loans, is separated from other loans on the balance sheet. So on the balance sheet, we see one asset called loans, the other asset which is a pool of mortgages, which is a cover for this bond. So on the balance sheet, the mortgages still exist, and this against this pool of mortgages is this bond typically being issued, and it lies on the balance sheet. And of course, whatever the principal and interest that are paid, they are guaranteed. They are guaranteed by the originator, by the they are guaranteed by the originator, which means they are not based on the performance of the underlying mortgages, not on performance of the underlying mortgages. They are guaranteedly paid. Means logically they are not true securitization kind of instruments, because in a true securitization we are talking about based on the performance of the pool, we see the cash flows, the principal and the interest are paid to the investors. So, and even this particular entity is not bankruptcy remote also. In general, when in a typical securitization transaction, we talk about the entity which is issuing these kind of bonds is generally high rated bankruptcy remote kind of an entity. So covered bonds have these kind of features, which is just a cover against a pool of mortgages, or probably a pool of mortgages act as a cover for the bond that are issued, and they are purely denoted on the balance sheet itself. Whereas on the other hand, we talk about another set of structured products called mortgage pass-through securities. This is probably a true securitization kind of transaction. The reason being, okay, all the loans, right? All the loans or home loans specifically, they are pooled, right? And they are sold to a third party entity. This third party entity, called as a special purpose vehicle, generally is bankruptcy remote, and this will issue the securities to the investor, and the cash flows from this underlying loan, the principal and the interest that come from this underlying loan, will be paid as principal and interest to these investors. So what is happening here is, when the loans are sold off to this third party, the third party is funding the cash here directly. So, which means these loans are directly taken out of the balance sheet of this particular entity. So, they are becoming pure off balance sheet transaction, and the payments here to these investors, they are purely based on the cash flows that are generated by the pool. And what we also see is, these are generally these instruments are called as mortgage pass-through securities. They have some kind of government backup to a large extent. When we say agency based mortgage pass-through securities, they have a government guarantee or a government backup associated with them, which means almost to a large extent you see they are bankruptcy remote, so the default risk chances are much lesser. But the major risk in this entire process is the prepayment risk. When the homeowners typically pay off their principal very early, even the investors also receive the principal very early. And generally it is observed that the principal is repaid early when the interest rates have fallen drastically. The reason is, the borrowers, they want to they want to refinance their loan at lesser interest rate. So obviously whatever the principal that this investors are receiving, they may not be able to reinvest them at a better interest rate, thus losing out. So that is one of the key risks that is associated with respect to this mortgage pass-through securities. Right? Now, the other set of important products which are a slight improvement over the mortgage pass-through securities, are the collateralized mortgage obligations, typically called as CMOs, collateralized mortgage obligations, more or less same as your typical mortgage pass-through securities or mortgage-backed securities. Loans sold off to a third party. The third party purchases the loans, pays the cash, and issues securities. If it issues the securities in a general form where the cash flows from this are flowing into this, that's a typical regular mortgage pass-through security. But if the securities are created into multiple groups, right, instead of one, if this entire cash flow or if this entire set of investors, probably I group into two or three categories. So it's like I have created three products instead of one product. Instead of one kind of a bond, I have created three or four or five kind of bonds, wherein the risk and return characteristics of each of these groups is completely different. Means the cash flows of each of the group are structured based on some predetermined conditions, rather than saying the cash flows whatever come from here are paid to these parties uniformly across. Rather than that, they are grouped based on something. Okay, this could be a 5-year maturity bond, this could be a 10-year maturity bond, and this could be a 20-year maturity bond. So either the grouping could be based on the maturity structure, or it could be based purely on the interest rates that are being paid, the coupon rates. This could be a fixed interest rate bond instrument. This could be a floating instrument, floating rate bond instrument. Or sometimes the categorization could be on credit risk. So whatever may be the payments that are coming from here, this bond will receive a fixed payment, even if we get more from here or less from here, this set will be paid the same amount. Any excess or deficit will be taken by this group. So based on the credit risk also, this grouping can very well happen. So the instruments which are created purely based on multiple groups or otherwise called as tranches. So the multiple tranches based on the cash flows, that is what we call as collateralized mortgage obligation. Now, in a collateralized mortgage obligation, there could be different kinds of structures with respect to payment. Generally, we talk about a waterfall structure, or sometimes people use a sequential pay kind of a structure, wherein they say, okay, the cash flows we are structuring in such a way that, okay,